Hello everyone, this is Dr. K. Jagannayaki, Professor in MBA Department, Institute of Aeronautical Engineering, Hyderabad. So today I would like to discuss with you all about capital and its significance. So after completion of market structures and type of business firms, then it is essential to understand how to generate the capital and what is its importance in the business activities. So, after going through this topic, the learner will be able to understand the meaning of capital and what is its significance and what are the different types of capital, that and all we can able to study under this particular concept. So, let us start with the meaning of capital. So, capital in economics, it includes tangible assets such as machinery and equipment adapted for producing goods. So, capital is that it is also considered as the wealth or financial strength of an individual or a company. So, while referring to capital in economics, it implies that the factors of production adapted for creating goods that are not themselves a part of the production process. So, already we know that under a production process, we used to convert the inputs. Output is equal to it is the function of inputs, NL KT, right? So, whereas here the K stands for the capital. So, capital most important ingredient in business organizations. So, without capital, it is not possible to generate the goods and services. So, coming to the definitions of capital, capital consists of all those goods existing at present time which can be used in any way so that it can satisfy the wants during the subsequent years. So, this definition has given by Sir John Richard Hicks, a British economist. So, according to John, capital is everything that satisfies human needs. So, this also means that both the consumer goods as well as the producer goods can be called as capital goods, as they both satisfy the human needs. And second definition is that capital is the produced means of production. So this definition is given by Eugene von Bombauer, an Australian economist, and another definition by Professor Paul Samuelson, an American economist. So according to him, capital goods are produced goods that can be used as factor input for further production. So what does it mean? Means for production process, whatever goods you are going to produce, among those inputs, one of the most important element is capital. Then coming to the characteristics of capital, capital is a passive factor. See, capital directly it never involved in the production process, but it is an ingredient which is used passively to the production process. And capital is man-made. So this capital is produced by the man himself. They used to print the currency. So in that way, capital is man-made and it is not indispensable. And capital has high mobility. So if you observe the capital, we can easily mobilize. We can able to convert cash into other forms, and then other forms of goods and services can be easily convertible. So capital has high mobility, we can easily mobilize the capital, and it is elastic. So it depends upon the size or volume of production. Basing on that, sometimes we used to invest more capital and sometimes we'll invest less capital. So capital depreciates. So if you go on using the capital, it may not be increased, but it is depreciate in the long run. And capital is productive, and capital is temporary in nature. So whatever form we are talking about, cash, whatever amount you are going to spend on fixed assets, and in the production process, that is always temporary in nature, it is not permanent in nature. So capital is prospective and it is recalled as past savings. So whatever surplus amounts you have, that we are going to spend in the business in the form of shareholders' own funds. So that initial investment, whatever we are going to invest in the production process, that is known as capital. Then coming to the types of capital, basically we have four types of capital: debt capital, equity capital, trade capital, working capital. So coming to the first one, debt capital. A business can acquire a business can acquire capital through the assumption of debt. So debt capital can be obtained either from government sources or a private source. The sources of capital can be anyone, from friends, family, and from financial institutions. Even we can get the money from online money lenders, credit card companies, federal loan companies, and insurance companies. All these are some of the sources of debt capital. To attain debt capital, an individual or a company must have an active credit history. So, based on the credit worthiness of the company, even the financial institutions and banks, they are going to provide loans to the company. So, debt capital is then required to be paid at regular intervals with added interest. So, the interest rates vary based on the borrower's credit history as well as the type of capital obtained. Then second one is equity capital. So there are three different forms of equities, that are private equity, public equity, and real estate equity. So private and public equity generally available in the form of shares. So generally the companies, they are going to issue shares to the general public so that they can able to raise the minimum subscription in the form of issuing of the shares. So when a company lists itself on the public markets exchange, its public equity capital is raised. So this capital is received from the shareholders. So the private equity is not raised in the public markets and it usually comes from private investors and owners. Then third one is working capital. Working capital is the capital available for fulfilling daily obligations and it is the most liquid capital asset available. So generally working capital is the difference between current assets minus current liabilities. So current assets are those which can be easily convertible into cash, which can be in liquid form. We can easily market those assets. And accounts receivable plus inventory minus accounts payable, that is also known as working capital. So thus working capital measures a company's short-term liquidity and more specifically its ability to cover its debts, accounts payable and other obligations that are due within 1 year. The next type of capital is known as trading capital. So trade capital is held by firms and individuals that trade on a large scale daily. So, trade capital is the amount of money allotted to buy or sell various securities. Generally, in the stock exchange, if you want to trade with the shares, whatever capital invested to buy or sell some kind of securities, that capital is known as trade capital. So, investors look to add their trading capital. For this, they employ a variety of trade optimization methods. And these methods are intended at making the best use of capital by determining the ideal percentage of funds to be invested with each trade. So the investors generally, they don't want to lose their investment. They always seek for the maximum returns on their investment. So as a result, they prefer such kind of shares where they can maximize their returns and there should be a minimum risk. Then coming to the functions of capital, most of the important functions of the capital are listed below. First one is provision for subsistence. Second, provision for appliances, provision for raw materials, provision for marketing and sales promotion, and economic development. So everywhere we need to invest some kind of amount. So that is known as the functions of capital. So one can use for provision for subsistence, and provision for appliances. So whenever they want to invest some kind of capital on the day-to-day obligations, and also some we used to make purchases of raw materials. Sometimes we have to give the advertisement kind of thing. So for everything, capital is essential. Without capital, it is not possible to run the business effectively. So coming to the importance of capital, capital is considered as one of the most important factors for production. It helps in modern production systems, and some of the factors which make capital imperative have been discussed below. So, capital increases production and production capacity or productivity. So, here, how capital is useful to improve the production. So, being as based on the demand, if you want to supply the goods and services, we need to have sufficient funds, and these funds are utilized in making purchases like raw materials, technology, all those things. So just by investing the capital, we can improve the productive efficiency. And second one is it is the core economic development. So the economic development of a nation, it can be analyzed with the help of how much capital you have generated and how much you have invested in various sectors of the economy. So based on that, we can able to assess the overall economic development of a country. And capital generates more employment opportunities. If you have sufficient capital to run the business, if you want to maximize yours and you want to diversify your existing business, as a result, we can create more opportunities, employment opportunities to the younger generation, so that we can improve the overall economic development of a country. Then coming to the estimation of fixed capital requirement. So fixed capital means the money invested by a company in its fixed assets. So fixed assets means land, building, machinery. So whenever you are going to invest that kind of amount on these fixed assets, it is known as fixed capital, and which are to be used for a long period of time. And it is used for meeting the permanent or long term needs of the business. Then, how do we manage the fixed capital? So, rising fixed capital required by the firm at minimum cost and using it effectively sums up the management of fixed capital. So, generally, the decisions taken by a firm to invest in fixed assets is known as capital budgeting decisions. So, whenever the company they want to go with a new project investment proposal. So that time they used to assess the profitability wherever they are going to invest, whether it is feasible to the company or not, whether we can able to generate the returns overall their investment, that can be decided with the help of capital budgeting decisions. So a firm must take capital budgeting decisions carefully as it affects the profitability, growth, and risk of business in the long run. So it consists of decisions related to the purchase of land, plant, machinery, building, investing in advanced techniques of production, or launching a new product line. So, in those areas, the management has to make wise decisions, and that should be possible by analyzing the capital budgeting decisions. So, what factors affecting the requirement of fixed capital? So, the requirement of fixed capital in an organization, it depends upon various factors such as nature of business. So what type of business you are dealing with, whether you are going to produce the physical goods or you are going to produce the services. Based on that, the fixed capital will be. Then scale of operations. So whether would you like to go with a small scale, medium scale, or large scale business activities. Based on that, the amount of capital would be. Then technique of production. What type of technology you are going to adapt in your business to produce the goods and services, and growth prospects. So whatever business we are talking about, is there further scope for prospect or not? That also we used to analyze with reference to the capital. and technology upgradation. Now and then, even the companies they have to upgrade themselves due to the technological changes. Otherwise, it may not be very difficult for the companies to survive in the long run. Then comes diversification. So, investing uh, in one particular asset or shares, it is not advisable because it leads to some kind of losses. So, as a result, instead of investing all the funds at one place, it is better to diversify your investments into multiple options so that if one area, if you're going to get losses, that can be recovered in other areas. So that is known as diversification strategy. Then comes level of collaboration or joint ventures. So sometimes if you want to expand your business individually, you can expand. Otherwise, we used to collaborate with other people. So that is known as joint ventures. So whenever you are going to evaluate that particular decision, whether it is advisable to the company, whether the company may generate profits by going implementing that particular decision kind of thing. Definitely, the company has to depends on the capital budgeting techniques. Based on that, they evaluate what is the net present value or what kind of profits they may generate with the available options. So, based on that, they used to identify the profitable investment proposal. The next, availability of finance and leasing facility. So, then once you decided the investment option, then next we have to find out, do we have sufficient funds, whether the company is financially viable to opt the particular option or not. So that and all it depends how much equity capital with the entrepreneur and how much he has to get from the outside in the form of debt. Then next one is working capital. Excess of current assets of an organization over its current liabilities is known as working capital. So it can be defined as the part of total capital which is required for holding current assets. That is known as working capital. So first we'll discuss what is gross working capital. The investment in all the current assets like prepaid expenses, cash, inventories, bills receivables, etc., known as gross working capital. The gross working capital of an organization gets converted into cash within an accounting year. Then the list of current assets in order of their liquidity is given below. Cash in hand or cash at bank, debtors, marketable securities, finished goods inventory, bills receivables, work in progress, raw materials, prepaid expenses. Then second category is net working capital or working capital. Excess of current assets over current liabilities is known as net working capital. Current liabilities are a source of funds for acquiring current assets and are to be paid within an accounting year. So within that accounting year, we have to acquire the current assets and how much we have to pay to the current liabilities. So that is known as net working capital or working capital. When the current liabilities of an organization exceeds its current assets, then the net working capital of the firm will be negative. The net working capital of an organization depicts its liquidity position. The negative net working capital of an organization indicates poor and weak liquidity position. So, however, a positive net working capital indicates a positive liquidity position. So, based on the liquidity position, also we can able to analyze the financial performance of a company. Then, what factors affect the working capital? So, factors affecting working capital: the nature of business, scale of operations, business cycle fluctuation, seasonal factors, technology and production cycle, credit allowed, credit availed, operating efficiency, availability of raw materials, level of competition, inflation, growth prospects, etc. Then the methods of estimating working capital requirement. There are different types of methods. One is cash flow method, second one historical data method, third one industry and trade standards method, and fourth ratio analysis method, and fifth one management judgment method. So the companies may choose any one of these methods and they try to evaluate the working capital requirements in the organization. Then the main sources of funding are retained earnings, debt capital, and equity capital. So companies use retained earnings from business operations to expand or distribute dividends to their shareholders. So businesses raise funds by borrowing debt privately from a bank or by going public. So one can raise the funds in the form of debt capital or sometimes just by issuing the shares in the public. The companies may also raise funds. So the sources of funding in terms of three types: retained, debt capital, and equity capital. And financial capital is raised through capital markets in two ways. One is by selling bonds, which are like loans that the business will repay at a later date with interest, and other one by selling stocks, which are sold in exchange for the partial ownership of the business. So, by using these two ways, generally the companies may raise the capital. Then, coming to the capital structure means it is the combination, the mix of debt and equity ratio. So, what is the proportionate ratio of debt and what is the proportionate rate of equity? Based on that, we'll decide the optimal capital structure. So, the combination of debt and equity, if you see this particular diagram, it is 50-50. 50 by 50 means debt by equity. Debt 50% means equity also 50%. Out of 100%, you may take the proportionate value as 60-40 or 40-60, 65-35, and so on. So it depends on the business risk and financial risk. Based on that, we'll decide what will be the optimum capital structure of a firm. Then, coming to shareholders' funds, these are all sources. Shareholders' funds can be raised with reference to equity capital, preference capital, and retained earnings, whereas borrowed funds availed in the form of debentures, term loans, and public deposits. Then capital structure means it is the total debt ratio. So it should be decided on the basis of the size of the firm, liquidity, interest coverage, growth, tangibility, age of the firm, and so on. When you are talking about the size of the organization, it depends upon the scale of operations. So a small scale unit, it requires less capital comparatively than medium scale and large scale units. Then liquidity means which can be easily marketable or what type of assets. Like when you are talking about the current assets, they can be always in liquid form, which can be easily marketable. And third one is interest coverage. So interest coverage means it depends on the credit worthiness of the organizations. Based on that, they used to avail the loans from the financial institutions and other banks. So if your credit worthiness is very high, the interest rates also less comparatively with other people. Then growth. So based on the size of the firm, if it is large scale, there is lot of scope for further growth. And tangibility. Tangibility means everything they used to maintain in a clear form so that it will be full transparency and disclosure. You can see in case of the organizations with reference to their capital structure. And age of the firm will also influence the capital structure. Then coming to the functions of capital, the first one is procurement of funds. Procurement means it will here how we are going to get this funds. What are the sources of funds? Because procurement of funds objective is to minimize the total cost, and other function is utilization of funds. So utilization means whatever funds available with us, it tells us how effectively we can apply the funds so that we can maximize the returns. Then coming to the procurement, here we are going to discuss about two types of sources. One is long-term source, another one is short-term source. Long-term means own funds, which is known as equity loan funds. If you are going to get in the form of loan from banks and other financial institutions, then that is in the form of debt. So long-term sources, here we want to decide what is the proportionate ratio of debt and equity. Based on that, the organizations they are going to make capital structure decisions and finance decisions. Then second one, short term and long term here. Where short term means we are talking about the current liabilities. Example creditors, payables, etc. And whereas utilization of funds, short term investments means where one can invest in the form of stocks, debtors, cash in hand and cash at bank kind of thing. So these two are known as working capital management decisions. And third category is under long-term investments, fixed assets and projects. So whenever you want to decide how much capital we have to invest and wherever you are going to invest, whether we can able to generate the maximum returns at a given level of risk. So that can be assessed with the help of capital budgeting techniques. So the type of decisions are also known as investment decisions or capital budgeting decisions. Then coming to the importance of capital return maximization. So as we are going to evaluate the investment proposals in terms of risk and return. So the investor he always look for high return sales, shares or securities, and flexibility should be there so that we can easily mobilize the funds from one surplus units to deficit units. And solvency is also one of the important function and increases firm value. So capital reduces the financial risk by diversification into various assets. Then it minimizes cost of capital, and it is one of the tax planning tool and also optimum utilization of funds. Thank you.
Like, share and subscribe. Hit the bell icon for more updates.